How to invest in commodities. Learn what it takes to invest in commodities. Adding commodities to a portfolio provide diversification and can even offer a hedge against price exposure further up the value of chain of certain industries. Energy products like oil, gas and coal. Agricultural products like corn, soy, canola, pork and beef. Metal like gold, silver, copper and platinum all have well understood market dynamics and relatively simple financial instruments to act as a trading vehicles. Many commodities are priced according to the market demand and the need of further processing. In a world where many financial assets are derivatives, trackers, and derivatives of the derivatives, with a layer of market sentiment influencing their performance, commodities can offer a more direct experience. How to invest in commodities. Physical ownership. Owning a physical commodities mainly applies for precious metal. Gold and silver are two of the best known commodities that are used physical stores of value. Investor can purchase this metal form into a bullion with a standardized size and purity. Bullion bars are closest to its value to melt price, the market price for the metal if you melt it down. Owning precious metal is in a physical forms comes with the issue of storage, insurance, and liquidity. Commodities beyond precious metal have further storage issue in that the quantities are often larger and there is shelf life. So they must be sold within a given time frame. This is why commodities investors do not pursue physical ownership. To trade physical commodities, you need to find a reputable dealer and most likely a storage facility for your holdings. Future contracts. Future contracts are direct plays on commodity price. Future contracts are an agreement to buy or sell specified amount of commodity at a specified price and date in the future. Investors use leverage margin accounts to allow them to take larger positions with their existing capital. In the vast majority of trades, the contracts are cash settled. This saves an investor from having to take delivery of thousands of pounds of sugar or figure out how to market a thousand of head of cattle. Opening an account to trade futures contracts will often require an additional paperwork to enable margin trading and will as well a higher account minimum. The specific maintenance margin needed in an account varies with the value of contract being traded. Individual securities. Individual securities related to commodity processing or production can be assessed through a regular brokerage account. You can find the company using a stock screener or looking for the basic materials or energy sector company. Investors looking for a commodity exposure through company shares generally have gained some industry specific knowledge to be successful. For example, extraction companies in mining and energy have a well developed system of feasibility studies on reserve that in turn drive the stock value. Larger companies will have reserve in different parts of the world and in different stages of development, meaning the impact of any feasibility study is not a big deal and as long as overall operations are profitable. Mutual funds, ETF, exchange traded funds, and exchange traded notes. Products traded on exchange include commodity based mutual funds, ETF, and exchange traded notes, which can provide exposure to commodities. These are exchange-rated products that are specific to individual commodities. This is the pool invested fund to combine capital in the commodity pool. The actual mechanism of investment depends on what is outlined by the fund. The fund manager could have buy futures, option, or futures, share in companies in the sector, or even purchase and store physical goods. Alternative investments. Commodities are considered as an alternative investment along with things like real estate.